Hello everybody. Today I'm going to cover the Chartwell Retirement Residence Units. And this is one of the ticker name is CSH.UN. This is one of the REIT requested by one of my YouTuber subscribers, hopefully, and she I asked me if I can cover this on my stock. So this was on my list. So today I thought, why not just create my stock analysis on this, because this is a little bit beaten by the coronavirus, and we like to see why this is beaten and is this a good REIT, right? So this is not very okay. So first let me introduce myself and then we'll just go straight to the content. So myself is Pramod Kumar. I am a CFA charter holder and FRM certified. I also have my website rightsanalytics.ca. It has some courses as well, mostly for CFA, but level 1 can be taken by anyone, whoever is interested. Okay, in my channel I'll do mostly stock review, fundamental review of the stocks, when go over its 10K and all, and try to make opinion for the long-term investment perspective, just for fun. So if you like it, if you stay and like it, kindly subscribe and give a thumbs up to this video. Okay, so let's get started. So okay, so this is my agenda for today. So I'll overview the business. So this is what this Chartwell Residencies does. How is government helping the overall all the retirements? What is this same property occupancy rate, financial, what's their debt scenario, coronavirus, and then form opinion. So this is pretty much high level I have on my plate. So what is this, right? So if I go to the business, right, so basically their portfolio has these many services, right? That's what Chartwell Residence is. So basically they build these the units and for the long term or the retiree or the people, old people who need the long term care, right? So they provide this kind of service. So first kind of service is the independent living, where they provide the units, and like in the townhouse, bungalows, or apartments, where they provide the meal and housing and so on. So before why I'm going into this one, let me hide myself so you can see clearly all the screen. Yeah, the reason is for me is all giving you the I need to understand the business, right? What's the business? And if I don't understand the business, then I don't know how to value them. So try to make some sense of this business. So that's why even I'm sharing this with you. So basically, if I go from the higher the bullet point, basically they provide the more care rather than just the meal and services. So like 24-hour, if I come here, this is extreme, where they provide the nursing, just like a hospital, right? For example, if I try to compare with something like 24-hour nursing care, supervisor in secure sitting area, and so on, right? And for this kind of a service, they admission and fund, it's overseen by the local government agencies in each. So they also get help from the funding from the local government. But other cases, like which is the base case, like independent living or some kind of a support living, where they need the personal service area, I didn't see any mention of the government funding. So that's pretty negative as well. So they are totally dependent on the tenants, or maybe the whoever is occupying the units, the old age people, basically to pay. So if they are high quality tenants, then there is no problem in terms of the vacancies and all, right? Okay, so that's the overview. And for assisted living, they charge a little bit extra. Okay, so let's go next. So let's see in terms of the percentage in care of their business. So as we know, so independent support living, which is, if I go back, is here. So basically LTC, MC, and AL, maybe they should be charging more, right? So LTC is only 15% of their business, whereas memory care is only 1%. So most of them is 73%, right? Where independent support living, which is this piece, where they provide the the units and plus some personal assistant service available if somebody needed. Looks like, right? That's how I read this. So they are not here in these three. So from the revenue wise, I think, but this is if I believe if they have more assistant and living and all, hopefully they get support from the government and more stable income. Anyway, that's I'm expecting at the moment. That's just my opinion, right? Okay, on the geographical location, it looks like pretty diversified. They are over 50% in Ontario, but they have their footprints in Quebec and Alberta and British Columbia. And I also noticed they are heavily investing and building the new units after reading their documents. So just give something there as well. So they're growing well, and they've been for long, right? So that's why I also find most of them units 61% is their own, but they also basically share the ownership with other, right? So 30% somewhere they have, and somewhere they're just doing the managing service. So, but the large chunk is they own. So in addition to the long-term care and the retirement operations, so most of their operations, their business is divided into two pieces out of those services. So this is the long-term care operations, and the retirement operation is 90%. Okay, so let's go to the government grant. So government does provide, due to the COVID-19, they provide some kind of benefits to the retirement home. For example, Ontario is 20 million support, British Columbia 10 million. So they get some assistance or funds from the governments, which helps. But right, so that's what they mention in their document. Okay. So before I go further, let's see. Okay, so maybe let's continue. So the next one is the same Chartwell. So now we're trying to go why the stock dips, right? So that's one of the reason what it's mentioned here, that the property, the same occupancy rates is dropping, right? Is 85.7% as compared to in January, which is 88.14%. So that's one of the reason their share price is declining, right? So declined. So if I want to show it to you, so I bought this ticker onto the Yahoo Finance. So this shows the price is right now is only $9.14. So this is not very expensive ticker, right? So if you can see, this is brought from 2004 to now. It's dropped significantly, right? From almost from it was running at 15 and then it dropped to $8, right? And now it's trying to come back to $9, right? So this drop suddenly, so the whole market drops and this stock also get penalized as well. So, but if you see from the growth perspective, right? If I see, this is very, very slow growth stock. So if this is not so you can see this from 2014 or let's say from 16, this is keep moving around the same price, $14 to $15, right? And then suddenly drops a lot. Okay, so this is from the high level stock perspective. Okay, so now coming back, so that's what the company saying, but what they are saying, that substantially all the April May rent, which is after the rent, right? Maybe the occupancy rate is drop, but whatever the rent is due, it's get collected from the occupancy, right? So that's a good sign. So this means they have a good quality tenants. So that's what also it mentioned here, and I have highlighted that they mentioned there that their credit quality remains strong given the typical investment profile of Canadian seniors in our target customer demographic, right? So their target, who is the senior, is quite who is had the good sufficient income. Okay, so now let's see their cash flow statement. This is the quarterly statement I pick from March 19 to 2020, and then I'll compare with the first 3 months of this year and last year. All other statements I have reviewed, it's nothing outstanding there, so it's stable. So, and we can see also in the share price, which is pretty stable. So I don't want to go into deep in that. Okay, so let's see, because trying to see whether with the given COVID-19 and going onwards is the price is good. So that's why I'm trying to highlight those points which affect the price, and in my opinion, and then some red flags if I'll find, so which need to be think of from the future perspective, right? So one, we already find that this is the same property occupancy rate. The second one I also notice here, if you can see, the cash flow from the operation is significantly dropped from December to the first 3 months of the quarter, right? So it's pretty much half of that. But at the same time, they raise some cash from the financing activity, right? If you can see from here, and it's keep increasing, and it keeps, if you see from quarter to quarter, they paid a lot of money in September, but afterwards it's significantly increased. One of the reason, I'll hold off this for now, why it's increasing, for little bit of a suspense, but they are raising a lot of cash, a lot of money they are raising, right? Okay, and I expect this to be higher here, or at least not that much to be dropped. It seems like almost 50% dropped here. So that's one flag, another flag, right? Number 2. Okay, so let's say from there the results of operations, where this year we compare the first quarter income with the last quarter, and the 9 million, because this is in thousands, so 9 million increase, although in terms of the revenue, but the overall because of the direct operating expense is less, right? So if I compare this, you see from here a lot, right? So this is the net income. How much is their direct operating expense? This is like 65%. I did a math on that. That's a huge in terms of operating expense. And here maybe it's 62 or 63. I haven't computed, but it seems like that ballpark. So this means this REIT, who is basically building the apartment or the units or whatever you can say, and then they provide the services to the food and other kind of nurseries service, 24-hour maintaining. For the cause is good from the long-term perspective, healthcare and retirement perspective, this REIT, right? So that's what their core business is. But the problem here is they are not simply building the unit and collecting the rent and giving the cash flow from the investor. Okay, from the charity perspective, that's good, but there's a huge in terms of the operating cost. So that's the number 3 red flag I should have given to them. And the net income, although we should see the FFO for the REITs, and I'll also show that, but if I'll just see from the net income perspective, it's pretty much like a 5% of the net income, right? Which is the margin is very low, right? And the reason what they have given is, again, the same COVID-19. They have increased the direct operating expense to 1.2 million additional, and to reduce, and further to quarter 2 is 0.8 million. So that's, and also it's highlighted there, which I will go a little deep later on, the financing cost, amortization and impairment losses. So this is not good, right? So for sure the company is building, but why they have this problem suddenly in the first 3 months? Maybe one of the reason is because their the margin are pretty less, right? And we'll see more into this. Okay, so now as promised, this is their FFO, and FFO is decreased as well, 1.75 million. Why? Because of the higher financing cost. So now what is the problem? So problem is they have a huge debt, and they are raising money, maybe because they are actively doing the development. I see that a lot of development is going on to increase the scale of the business, right? Because to building those Chartwell in all over the country, and for that they take all kind of a debt. And some are secured, some are unsecured like debentures, and for that it increased the financing cost. And okay, so that's what I have highlighted here. The management cost is also increased 0.6, and you see it's also mentioned here that the lease up losses and impute cost of debt. So that's another look at here. So their management cost, the breakdown I have shown, the management increased to 0.5 million, right, as compared to last. The salaries also increased 375. Maybe they have to pay a lot to the people who are serving them, so that's one of the reasons, which is normal, but I don't like this piece honestly, higher financing cost. And this is their financing cost breakdown. So look at there, as compared to, this is 20 million and 23 million. Interest expense is 3 million, 0.4 million, 0.9 million in credit facility. Unsecured term loan is 1 million. So 2.6 million, right? So this is increased. Okay, now let me show you more in go into the deep. Okay, so now here I am in there showing on the screen on the debt. So as you can see from the compared to the just in the 3 quarter, they have increased the debt by 200, some almost like a 200k, but the mortgage payable is 1.9 billion. Their senior A debenture, which is unsecured kind of a loan, an unsecured term loan, is a lot. So they have a lot of debt on their balance sheet, right, which is also break down the weighted interest, which is going over 3 to 4%. This is what they are showing, and a remainder of that, right? So from this year is they need to pay 57 million principal, right? Then for next year 75, 70, and so on, right? So this is what their debt structure. I think this is very clearly seen is here, right? So amortizations is the blue line, and principal due on maturity, right? This is, maybe we just look at here, right? So look at here. So this year is little over maybe 100 and close to 50, and then it's over 300 and 24. So the debt is pretty much increasing, and here this is not only this is the debenture as well, right, which is not secured kind of a loan. Okay, so the debt is a lot of debt because they need to grow and build, but still I find it's not that great, especially if they're unable to, their margin is pretty low, right? So that's, I also want to show it to you. And then and then one more thing, I think their rating on the debt is like a junk bond rating, right? So usually that's the DBRS, one of the rating agencies, and anything below BBB is not a good quality of on debt. So it's lower, so that's why they have to pay higher fees in terms of the interest expense and all, which is clearly seen in their one of the in their net incomes, right? And their income is lower by that. I don't want to go deep, but that's a high level we can see from here. Next is, let's see from the coronavirus. So now here I'm seeing, I just did a Google and then see how many. So look at here, right? So 4 dead in at Ajax nursing home, right? Chartwell, 11 dead in somewhere. So these are like every some month. So they are pretty bad in terms of controlling the seniors on the coronavirus. So I think they should have a bad image now, although they claim in their MD&A that okay, they are doing pretty good job, but I think it's not, as what we can see, right? Even their staff member here, Miss Saga News, right? I was reading that it's got affected by the coronavirus, right? So you can easily Google it and find it, right? And so that's another negative point I find about it. So what next? Okay, so pretty much they if I see from the investment perspective, okay, so they have a pretty bad debt, but they are also taking the debt in terms of the growing. So once that unit is available, then they can rent more and generate more. So from that perspective, and second perspective is their coronavirus, they're unable to handle. I think this company should do well in order to protect the seniors and for that. So, but it certainly affect the image. But third thing I find is, okay, so it's pretty stable. I think the stock will come up back, but what I'm seeing here is the margin are pretty lower and their operating expenses quite higher, and the growth is of the stock is very, very low. It's been stale for few years. Maybe it takes 1 or 2 years to come back once they pay off their debt and once more unit is available, so they can have a more revenue. But you never know, then the company will take further debt to grow their business, right? So it's taking a debt, building a units, and have the, if I summarize, right, and have the expensive staff in order to run that business, right? So for sure they having good revenue, but the revenue has a higher expense, operating expense as well, which is not good. And the second worst case is they have to pay higher interest on their loan as well, which is also not good. So from the investment perspective, yeah, maybe there are a lot of other options also available, but if you think still it suits your portfolio, go ahead and invest that. I don't think that this is very remarkable REITs. There are maybe other options available. I'll try to cover other REIT as well, but from the pure investment, the cash back, it's not good. But yeah, if you want to support like this kind of venture, go ahead and do that. So I'll put all the pros and cons. Hopefully it's good for you if it suits your portfolio to make the decision. Okay, so if you like it, kindly subscribe, and and if you already subscribe, like this video so more and more people will get this video and able to view it. And if you want me to cover any other video, kindly put in the comments. So I didn't realize that my face is still off for a long time. Okay, and thank you for giving me the opportunity to make this video and analyze this stock. And if you want me to do anything else, please put in the comments. See you in next video. Bye for now.